When it comes to your retirement, do you want to have the same old plan everyone else has? Of course not. You're unique and have your own goals and dreams. Don't be treated just like a number. This is your retirement. So it's time to think differently. And you're in luck because you've found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic, run-of-the-mill plans containing the same old cookie-cutter solutions. Dave, Chase, and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. And that means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hats and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now.
When it comes to retirement, do you want to have the same old plan everybody else has? Of course not. You're unique and you have your own goals and dreams. Don't be treated just like a number. This is your retirement, so it's time to think differently. And you're in luck today because you found the Retire Your Way podcast with ILG Financial. At ILG Financial, you won't find generic run-of-the-mill plans containing the same old cookie-cutter solutions. Dave Lopez, Chase Lopez, and the ILG Financial team focus on building one retirement at a time using their Think Differently philosophy. That means your own comprehensive plan with customized solutions built to achieve just one goal, yours. So put on your Think Differently hat and get ready to take back control of your retirement today and for all the tomorrows to come. ILG Financial's Retire Your Way podcast was created just for you, and it's starting right now. I'm Ron Stutz, and today we're going to talk with Chase Lopez about stocks, U.S. stocks as investments over the long term, and some truths and misconceptions for retirees to keep in mind. Chase, how are you today, sir?
Doing great, Ron. Doing great. Great to be here with you today to talk about stocks. It'll be nice. I think this one's a little bit different. We're kind of getting back to the fundamentals a little bit with this one. So I think we're going to get some great information for folks.
Yeah, and speaking of fundamentals, I mean, we're getting right down to the bottom line here. We're going to talk about stocks. So why don't you begin by just telling us all what stocks are and what we need to know?
Yeah, so I think that's kind of a great starting point, right? So a lot of times when people talk about stocks, I feel like they kind of lose the plot a little bit, right? You see a ticker in your account, right? And you see it go up and you see it go down. But I think it's a good reminder to remind folks what a stock actually is. So with a stock, if you own a stock, right? Let's say Apple stock. We're going to use that as an example as we move through the podcast here today. It's probably the one that most people can identify with.
A good example, yeah.
Yeah, exactly. So if you own a share of Apple stock, you are a part owner in Apple, right? You own a piece of Apple. That share represents a piece of the company. So when you see the stock price go up and you see the stock price go down, the value of the company itself is fluctuating, right? So if you see, your Apple stock is up 1% in a day, a month, a year, whatever the case may be, that means that the value of the company over that time period went up 1%. So as what we call a stockholder or a shareholder, another name for it, you are a part owner in the company, so you participate in the company's growth over time if they grow. You also, and we'll talk about this today, you also partake in the loss of a company, right? If the company goes down in value, you also participate in that. If the company is distributing profits, right? Dividends is what a lot of people are familiar with. That's just a form of, or a way for the company to have its shareholders participate in the profits of the company. So they're distributing those profits to you. So whenever we're talking about stocks, I think it's very important to understand, hey, this is not just a line item on your account, right? You are invested in the company stock that you hold.
I think this is really helpful today because, everybody talks in terms of the stock market and how stocks are doing and all this kind of thing. But I think it's helpful to get back to the basics and kind of explain exactly what that is about. And why don't we talk about stocks as investments, because that is such an important topic.
Oh, yeah. If you talk about investments, I would say stocks are probably the most popular to talk about, right? Now, that doesn't mean it's the biggest, investment pool, but it is kind of the most popular to talk about. So when it comes to stocks as investments, the main thing to keep in mind is that nothing is guaranteed, right? Oftentimes folks will cite the stock market has averaged, between 7 and 10% over the last, X amount of years, which is true. But just because that was the case previously does not mean that's going to be the case moving forward, right?
Yeah.
Nothing is guaranteed with respect to the stock market.
Yeah, people are often talking about past performance, but that's not necessarily the way it's going to go in the future.
That's exactly right. But for the most part, even with, losses in the short term, right? U.S. stocks have delivered gains over the long term if you look back historically, right? So while historical performance doesn't necessarily mean that forward performance will be exactly the same, we do have about 100 years, or 100 years plus, really, of data to support that over long periods of time, U.S. stocks do go up over, long periods of time. Mm-hmm. Now, oftentimes folks will say, well, Chase, what does that mean? A long period of time for me could be a lot different than a long period of time for you, right?
True.
So typically, right, folks will say a long period of time in the stock market is 10 years or more, right? So oftentimes when we talk to clients, we often say, hey, look, the money that you have in the market, you want to be comfortable leaving it there for 7 to 10 years untouched, just in case the market does go down, right? Market does go down on occasion for a variety of reasons. And there are cases where, that 10 years may not be enough. And we'll kind of go into those. But I think the bottom line there, when you talk about stocks as an investment, especially individual stocks, right? Buying individual stocks in individual companies, they can be risky, and that's by design.
Yeah, and it's, important to leave your money in there long enough for it to recover if things go down. So
100%.
There's something to think about there. Listen, if you'd like to have your own conversation with Chase Lopez about the stock market or anything else, call ILG Financial at 540-720-5656, or, of course, go online to ilgfinancial.com to learn more. We're talking about stocks today, and we've talked about stocks as investments, but what about international stocks? We all hear a lot about investing internationally. What's that all about?
Yeah, so I think when we talk about stocks in general, right, oftentimes when we talk about the stock market, people will think of the S&P 500. So the S&P 500, those are just some of the 500 of the biggest U.S. companies, right? And that's oftentimes what people think about when they think about the stock market. But to your point, there is a whole world of stocks out there outside of the U.S. that are available for investors to invest in. Now, those are called international stocks, right? Because they're not U.S. companies. Mm-hmm. So with that said, those that have been investing exclusively in U.S. stocks since going all the way back to the 1800s have been relatively fortunate, right? U.S. has done a fantastic job of being the business engine of the world, right? Over the last 200 years or so. Right. Outside of the U.S., though, we have seen examples of losses that are much longer than what we're used to in the U.S. So a couple examples are between 1959 and 1979, the Italian stock market lost 78% over that 20-year window. So if you would have started at the beginning, you would have been down 78% over that time period.
I didn't realize that. Wow.
Yeah, a more recent example is the Japanese stock market. It's called the Nikkei. In 2009, the Nikkei went down about 65%. So that's 2009. We're recording this in 2025. So what's that? 16 years ago or so, right? Yeah. Only recently has the Nikkei reclaimed those all-time highs that it had back in 2009. So that's 16 years, and that's a modern example of 16 years of basically nothing in some of those international markets.
My goodness.
Yeah, there are other examples out there, but one thing to kind of keep in mind is, again, this is not to say that those things cannot happen in the U.S., but if we look back at history, a lot of those international markets have had a tough time keeping up with the U.S. over the long term.
Yeah, that's for sure. There are some other, countries where that has happened. Like I understand Norwegian stocks have the same kind of history. German stocks, Swiss stocks. My goodness, all of those have not done nearly as well over time as the United States.
Yeah, and a lot of folks will ask, well, why does that matter, right?
Yeah.
Why does what international stocks do, matter to us, especially to investors here in the U.S.? One reason I would say it matters is if you look at your 401k or your IRA, you may have more international stock exposure than you realize, right? A lot of times inside of 401ks or IRAs, you'll be invested inside of what they call mutual funds, right? So a mutual fund is just a fund that holds a lot of different stocks in this example, right?
So actually, those international stocks really do affect a lot of us directly.
100%. And the reason why I like bringing that up in a forum like this is a lot of times the phrase that I use is you want to know what you own, right? So if you own, I don't know, so-and-so mutual fund, right? Mm-hmm. Really what you want to understand is, okay, this mutual fund is a basket of stocks in this example. What exactly is in this mutual fund? Do I have some international exposure? Now, even if you do, this is not some sort of recommendation to not have international exposure, but it's nice or it's advised, I should say, to really understand, hey, how much international exposure do I have and am I comfortable with that, right? Even if, it's all in the U.S., right? Let's say all of your investing is in U.S. stocks. U.S. stocks aren't immune to some of the forces that, ended up hammering, Italian stocks, Japanese stocks, German stocks. So just because the U.S. stock market hasn't had a period like that doesn't mean that it can't. So it's very important to work with your financial professional to see how, those stocks that you're invested in, whether that be through mutual funds, ETFs, or individual stocks, how those fit into your retirement and your investment plan, big picture.
Well, you have talked about so many times, you and Dave have both talked about how it is so important to know exactly what you have, what kind of risk you have in your portfolio, and it's so important to know what's in there, and this goes right along with that. The long run, you talked about how it's important to, invest for the long term and give the market time to recover if it goes down, that sort of thing. But the long run can compound losses if that happens.
Oh, yeah, absolutely. So, I think compounding, rightfully so, gets a very good rap, right? When we're talking about compounding, right, we're talking about over long periods of time, your account growing, and that kind of compounds on itself over time. Right.
Yep.
So in the long run, if stocks go up, compounding is great. Right. And we've seen that in the U.S. stock market, like I mentioned before, over the last 150, 200 years.
Yeah, we all count on that. Yeah,
that's exactly right. That's exactly right. The inverse of that, right, is what we saw in some of those international markets, which is the losses can compound as well. Right. So if your account goes down, 10% a year, and I'm not saying that will happen, of course, but let's say in this hypothetical, your account went down 10% per year over a 5-year period, you'd be down from top to bottom more than 50%, right? Because of compounding. It works in the inverse direction as well. So reason why I bring that up is to kind of go back to what we were talking about before, which is, being in the market by definition is a little bit risky. Now you can mitigate that in a variety of different ways, but it's important for folks to know, especially in times where folks get, a little complacent, right, in the markets, just to understand, hey, when you're in the markets, it is by definition a little bit risky. You can mitigate that risk with being in there for the long term, which we've talked about. And also you can mitigate that by what we call diversification.
Yep.
And we've talked about that, several times here in the podcast, I believe.
Well, we have talked about diversification so many times, and it really is important to be diversified, and you have to make sure that you are truly diversified. A lot of folks out there think they're exhibiting diversification when they're really not after you get in and analyze their portfolios, and that's why it's so important to talk with a financial professional like Chase Lopez to find out if you are diversified, and if you're not, you can take steps to make sure that you are.
That's 100% correct. And I think, especially in times like these, it's important to, going back to what we talked about before, know what you own, right? So one of the biggest reasons diversification is important is by diversifying, you eliminate or reduce some risks out there, right? Mm-hmm. So the first one that you eliminate by diversifying is what we call company risk, right? And all that means is, let's go back to our Apple stock example, right? If you have your entire portfolio invested in Apple, and something happens specifically with Apple, right? Something happens with the CEO, they're behind in some sort of product cycle, whatever the case may be, you are beholden to what happens with Apple. So let's say the rest of the stock market goes up, but something happens specifically with Apple that makes the Apple stock price go down. Well, then, you have some opportunity cost there that you're losing by only being in that one company, right? And that could have negative impacts on your overall plan. So if you have, broad diversification, you have exposure to U.S., international, small companies, mid-sized companies, large companies, then, what happens with Apple individually won't necessarily affect your portfolio as much, right? And some of those other areas of the market, the small, mid-sized companies, international, there are periods of time where those may do better, right? So it's important to have that broad diversification and not have, too much of your eggs in one basket, as the old saying goes.
Yeah, I think it's really important to have this conversation that we had here today so that we could all understand the stock market a little better, the importance of diversification, of course. And Chase, before we go today, this has been a really good podcast, I think, because you've done a good job explaining this. Before we go, is there a takeaway that you can give us all from this conversation in general that folks ought to remember?
Yeah, I think the big takeaway is that stocks don't cease to be risky investments once they're held for decades, right? I think that's a common misconception that, hey, if I just hold it forever, right, eventually it will go up. That has been the case in the past. Doesn't mean that'll be the case in the future. So just acknowledging, hey, stocks are, relatively risky, but investors can mitigate their losses by investing in a more broadly diversified, low-fee index fund type of environment and refrain from trying to do things like day trading, right? It's often a fool's errand. But the most important aspect is to make sure you have the right money in the market for the right reasons. And that's different for everyone, right? But working with your financial professional when it comes to how much you should have in the stock market, especially in or near retirement, is of the utmost importance, I would say.
Yeah, and this stuff is even more important, the closer you get to retirement, the older you are.
Oh, absolutely. Absolutely.
You're one step closer now to learning what a customized retirement strategy can do for you. Income, legacy, growth. It's all right here at ILG Financial, and it's about helping you plan your retirement your way so you can achieve your financial goals. Call ILG Financial at 540-720-5656, or you can go online to ilgfinancial.com to learn more. This has been the Retire Your Way podcast with ILG Financial, Chase Lopez. I'm Ron Stutz, and we'll talk to you next time. The information provided is for educational purposes only and is not intended as investment advice for any individual or entity. All information contained herein is believed to be from reliable sources. However, we make no representation as to its completeness or accuracy. The views presented today are those of Dave Lopez and do not necessarily represent the views of the Alpha Star Capital Management, LLC. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Investment advisory services offered through Alpha Star Capital Management, LLC, a registered investment advisor. Alpha Star and ILG Financial, LLC are independent entities. SEC registration does not constitute an endorsement of the firm by the Commission, nor does it indicate that the advisor has attained a particular level of skill or ability.
Hey, Chase Lopez here. Thanks for listening to Retire Your Way with ILG Financial, our podcast. Make sure you head to our YouTube channel as well to check out our video series, Retire Your Way with ILG Financial. Also, don't forget to subscribe and like our videos there so you can be alerted for any future videos. Talk to you soon.